Hi students, good evening again. We were discussing about the break-even point, the cost volume profit analysis, means the CVP analysis. The same topic we will continue. In the previous lectures, we have discussed briefly about what is the cost volume profit analysis, what is the break-even points, how it is calculated. So some of the calculations again we will do. There are some informations given here. For example, the sale price per unit, then the variable cost per unit is given, then the fixed cost per period is given. Okay, we just assume some of the values. For example, we say that the sale price per unit is $15 per unit, and the variable cost we assume that is how much, that is $10 per unit, and the fixed cost for that specific period is $5,000. Okay, now the expected sales, what is meaning by the expected sales? Obviously, whenever the company is manufacturing any product, they're making the budgets, so they are budgeted on the expected sales for the next period. We just assume like a 1,600 units. Means it is their plan, or it is their expectation, or as per the you can say the estimation of the budget team, or as per the estimation of the sales team. They have an idea they will be able to sell 1,600 units, and the target profit, what they expect that they want to get a profit, let's say they want to get a profit of the $6,000. So this is the information that is given in the question, that what is the sale price per unit, what is the variable cost per unit, what is the fixed cost per unit, then how much is the expected sales for the next period, or the budgeted sale for the next period, and what is the target profit. So what is required now, we have almost 5 requirements, or the 5 basic things that we have to calculate. The very first thing is what is the contribution margin per unit. The second thing is the break-even point in the volume, or what we say in the number of units, that how many units they have to sell to get the break-even point, or to achieve the break-even point. The third thing is the break-even point in the value, or in the dollars, means if we transform that units into the value, that how many units they sell and what will be the value of those units, so that is the break-even point in the value. The next thing is what, that is the margin of safety. So this is the new concept. The margin of safety means after the break-even point, how much still they are safe from the loss. So when we will calculate it, we will discuss in detail. Then the last thing is the target profit units, means if they want to get a profit of $6,000, how many units they have to sell. So we calculate these things one by one. The very first thing we are going to calculate is what is the contribution margin per unit. So contribution margin per unit is simple, that is the sale price per unit minus the variable cost per unit. So how much is the sale price? Means they are expecting that the one unit will be sold for $15, and also they have an expectation, they have a calculation that the variable cost will be almost $10. So 15 minus 10, so it will be $5 per unit. Means one unit, if they are selling, it is contributing towards the profit how much? Almost $5 as a contribution margin. So contribution margin is what? So if they are selling one extra unit, how much it is adding to the total profit of the business. Now the next thing that we have to calculate is the break-even point in the volume. So I hope you remember the formula, that is the break-even point, and the break-even point we are calculating in the units. So that is how much calculated, that is the fixed cost divided by the sale price minus variable cost. So very simple calculation, that we have 5,000 divided by 15 minus 10. So the answer will be 1,000 units. So sometimes some of the students make the mistake that they divide this 5,000 with 15 and then subtract the 10. Obviously this is not the correct thing. What we have to do basically, first we have to calculate that one, 15 minus 10. How much will be the answer? That will be 5, and then this 5 will be divided with 5,000 to get the exact answer. So 1,000 unit is the break-even point. Means if they are selling 1,000 units, they will be in a no profit, no loss situation. So they will be able to achieve that point. And after that, means after that 1,000 units, there will be a profit. Means if they are selling 1,001 to 1,500, so there will be a profit region. But if they are selling less than 1,000 units, it will be a loss region. Now the third thing that we have to calculate is what is the break-even point in the value. So that the break-even point, again, break-even point in dollar is what is the break-even point in units multiplied by sale price per unit. So we have a break-even point in the previous thing we have calculated, that is the 1,000 units multiplied by with $15, that is the selling price. So it means $15,000 is the value of the break-even point, or the value of the break-even point. Means if they are selling $15,000, the value of the sale is $15,000, they will be able to achieve what? They will be able to achieve the break-even point. Now the next thing that we have to calculate is the margin of safety. The margin of safety has a very simple formula. Margin The margin of safety is simply that we have an expected sales minus the break-even point. Means if we calculate here the expected sales, they are expecting that during this year they will be able to sell 1,600 units, and the break-even point we have just calculated is 1,000 units. So the answer is 600 units. So now what is the meaning of the break-even point? The break-even point was what? That if they are selling 1,000 units, they will be able to achieve a no profit, no loss situation. Now, what is the margin of safety? The margin of safety is simply how much extra sales they are getting above the break-even point. Their expectation is that they will be able to sell 1,600 units. Means the 600 units they are selling extra or above the break-even point. Means why we are calling it as a safety? Even the sale, it is expected sales. It is just assumed that they will be able to sell it. But even if their expected sales drop by 600 units, still the business will be safe. Safe means what? That there will be no loss for the business. Even their expected sale reduced by 600 units, but still they will be able to achieve the break-even point. So that's why it is called the margin of safety. Means still they have a margin of 600 units. Even there's a future things, there are maybe economic conditions are not good, there may be other possibilities, for example due to some inflation or due to the customer shift. Still, if there's a 600 unit reduction in the sales as per their expectation, there's a variance of 600 units, still the company will be safe. So this is the concept of margin of safety. And in this question, we have a 600 unit as a margin of safety. Means even if their sales, expected sales drop by 600 units, the company or the business will still be safe. Safe means there will be no loss to the company. At least they will be getting the break-even point. It is above 600 units above the break-even point. And the last thing that we are going to calculate is what is the target profit units. Means they want to get a profit of 6,000 units. To get this profit, how many units they have to sell? So the target profit unit is again a very simple one. Target profit is the fixed cost divided by the sale price minus variable cost. That is the same formula that we have used here for the break-even point. Just what we have to add, we have to add the target profit value. Now, the fixed cost, that is 5,000, plus they want to get a profit of 6,000, and the sale price is how much? That is $15, and the variable cost is $10. So it means here it is 11,000 divided by 5. So the answer is 2,200 units. So means if they want to achieve the profit of $6,000, they have to sell how many units? 2,200 units at these prices or at this cost. Considering all the things, if they want to get a profit of 6,000 units, what they have to do? They have to sell how many units? 2,200 units at these prices level or at this cost level. So this is the concept, how we are calculating the break-even point, how we are calculating the contribution margin, how we have calculated the target profit, and even the margin of safety. So this is the concept for today. So we are going to discuss the more things related to, for example, if there is any change in the sale price, change in the variable cost, or the change in the fixed cost. So what will be the effect of those changes on the break-even point? So these are the things we are going to discuss in the next lectures. Thank you very much.